Experts have highlighted two key issues in Bangladesh's banking industry. The first is that a few important individuals hold too many banks. They have routinely authorized loans to subsidiaries of other bank owners or persons linked with them who are among the country's worst defaulters. An increase in non-performing loans, NPLs, is linked to the second issue. Both are the outcome of our regulators' actions or inaction. The Bangladesh Bank has ruled that banks may designate borrowers as defaulters if they repay just 15% or more of their entire loan installments due, down from 25% in 2020. Banks may also account unrealized interest on 85% or less of loans, up from 75% the year before, even if the loans were not paid. Due to this loose approach, borrowers paid just 15% of their loan balances for the year. A reduction in the provision requirement increased most banks' operational earnings in 2021. Experts say the high operational profit reported by banks overstates the true amount, which is risky for banks. The most obvious issue is that banks will never get the full sum owing to them, which they have already included in their operational earnings for 2021. Nowhere in the world does the financial system function like that. And following the epidemic, Bangladeshi banks' track record in retrieving such cash deteriorated further. So the banks' balance sheets have become more unreal. Doximament, by overstating their revenues, banks are able to give bigger dividends to their owners and shareholders without really generating any more money. However, given the central bank's past record of enforcing its own set of laws, one doubts if the central bank or commercial banks will truly do so. Third, by increasing profits and hence dividends, banks raise their stock prices, not by improving efficiency or productivity, but by simply manipulating the statistics. Regulators applaud them, despite their obligation to prevent such accounting fraud. Lastly, this will distort market activities. In a free market, the market should set prices, that is, decide what something is worth. Regulators who allow such accounting changes disable the market's ability to set prices. Such market distortion is risky, particularly in finance. The Bangladesh Bank issued the above instruction only hours after meeting with some of the country's top business executives at its headquarters, despite our knowledge that the central bank has not conducted any research to assess the impact of its decision on the wider economy. This is not the first time that special interest groups have intervened in the financial sector. For example, when chronic defaulters were left unpunished, while the state opted not to punish the willful and habitual defaulters, but to bail out the banks with public money. Even if banks were plainly comfortable with, if not participating in, the corruption that ruined their balance sheets, it occurred. The state opted to offload the losses incurred by the willful defaulters by utilizing taxpayer funds to bail out the banks. Financial discipline and a strong banking sector cannot come from these methods. These initiatives plainly do not serve the public or the banks. While the Bangladesh Bank lets banks seem to be doing well, they are really getting more susceptible. According to the central bank, this measure was required to help firms recover from pandemic-related difficulties. And it is correct that the government should seek business-friendly measures to revive the economy. We support such measures. However, the Bangladesh Bank's approach may encourage deliberate defaulters and cronies while hindering legitimate firms from operating within the law. The authorities' prior actions and inability to halt one fraud after another have undermined our already fragile banking industry. In the end, it is crucial that legitimate enterprises that provide value to the people be supported by the government, not those that profit from government subsidies by lobbying. How does the central bank plan to guarantee that this does not happen, considering recent events in the banking sector? Globally, governments are helping companies recover from pandemic-related losses. Simultaneously, almost all central banks worldwide are pressuring commercial banks to increase provisions to offset pandemic-related risks. No operator are fairly inverse. It is perilous to loosen financial discipline and enable frequent defaulters to possibly have greater access to bank loans, even if the Bangladesh Bank has requested banks to keep 3%, on top of the present 1%, contingencies. Again, one must question the Bangladesh Bank's choice. Was there a case study? The Fed owes the public an explanation.